and welcome to the quarterly market update for Q3 2024. I'm Hannah Kennedy and I'm joined by Dr. Scott Osborne. So, Scott, a lot has happened since our last update, which we seem to be saying every time, but it's true. Let's talk politics first, particularly maybe the US and UK political landscape.
Yeah, obviously we had European Parliament elections as well, but US-UK is the one where there's been probably the biggest changes, right? So taking them one by one. I mean, the US election first, this was already a pretty wild race between Biden and Trump, right? We did not expect an assassination attempt on Trump. It probably was a little bit more likely that Biden did back out at some point, but basically the funding completely dried up and he was kind of forced to step aside. They've not officially backed Kamala Harris yet, but it seems like that's the most likely outcome. So we now have this Harris-Trump election, completely different story to Biden-Trump, and it's early days on the polling, but it now looks like it's gone from a pretty reliable Trump victory, or at least a lean towards Trump, towards a complete toss-up again. And there's various sort of intricacies on the voting there in terms of how Harris votes with black voters, Latino voters, whether Trump can hold some of the gains he's made on Biden. But fundamentally, this is going to be one of the most materially market impacting elections when it finally lands, but also one of the most uncertain. So at the end of the day, it's a coin toss. We don't even know what the policies are from both sides yet. So there's not really a lot we can do other than this continued watching brief, which is, we have a good handle on that. But we're not, not worried about it specifically, and we're certainly not making any changes around it. I guess the surprise, which is no longer because it's happened, was the UK election coming a bit early. And we said multiple times here that we were never worried about the UK election. There's still little room for the incoming administration, that there was never going to be any huge overhaul, and that's basically what we've seen. Boring old Keir Starmer has been true to form. I suppose the big questions are around, at least for market-related stuff, is this business environment. They have this growth plan, quote-unquote growth plan, targeting 2.5% GDP growth, which is more like the pre-financial crisis level of growth we had. Is that achievable, given they've got very little actual spending power? And how can they engineer it? What policies are they basically going to use to try and get a bit of growth or increase that rate of growth? There's a whole other question around the tax and spending picture, and it's probably less impacted on markets, but will be important for the financial advice side. And I think we've said, it's probably a good time to speak to your financial advisor as some of these changes come through. But generally, we're pretty positive on the UK because we have a stable government with a responsible fiscal picture. Obviously, recently Rachel Reeves has come forward with this kind of 22 billion black hole, and so they're already teeing up how they're basically going to fill some of that hole with tax rises.
Sorry, just to cut you off there, Scott, one of the things that they have done already with this big black hole, is that partly made up by the big public sector wage increase?
Yeah, definitely. There's obviously a good bit of politics there that you blame black hole in the previous administration, when half of it is basically a decision you made last week on an above inflation increase in public sector pay. Yes, well, it is kind of. There's a lot of talk about the risk around that, about inflation. Obviously, wages feed directly through to consumer spending. Consumer spending drives prices, and prices are inflation. I think, in fact, Andrew Bailey was asked basically a form of this question yesterday at the Monetary Policy Committee, and I think his answer is correct, which is that actually, historically, when we look, public sector wages lag private sector wages. So it's really always private sector wages where you want to look at that as the indicator for future inflation. And we've seen private sector wage growth slow. So I think this one-off big spend is probably a little bit of catch up in the public sector, the private sector. I wouldn't necessarily worry that that's going to lead to a huge increase in inflation, and that was certainly the kind of angle that the Bank of England took on it yesterday. But it definitely is an indication of some of the government's spending priorities, right? And so it will matter where and how they raise this money and where they spend this money for the progression of the economy, and thus, the business environment and markets ultimately, yeah.
Brilliant. That brings us nicely onto interest rates. Interest rates were cut yesterday, as we record today, to 5%. Does this mean that the war on inflation is won?
No, is probably the straightforward answer, right? I don't think anyone would be, definitely after the last 3 years we've had, we're very cautious on declaring victory. But it obviously is a very clear signal that the bank and the Monetary Policy Committee feel that policy is restricted, has been restrictive enough to tackle inflation, and obviously inflation is basically at target now, but it is going to re-accelerate very slightly over the course of the year. But they're basically saying, listen, policy has been tight enough to bring inflation back towards its target. It doesn't need to continue to be this tight going forward to continue that trend. So they can afford to reduce interest rates and still see inflation come down towards target. And this is the conundrum for all central banks. And obviously what they basically want to do is get to what we call the neutral rate, which is okay, nobody knows what this is, but at some point there is a number for interest rates which will basically keep the economy rate of inflation at 2%. And we don't really know what that is, but we know for sure it's less than it is today, because he said that yesterday. It's almost certainly not what it was post the financial crisis, i.e., basically 0 or 0.5%. It's in fact, Andrew Bailey again basically said that himself. We're almost certainly going to be above that, but we don't know how many cuts we have to go to hit this neutral rate, and that's where the debate's going to shift towards now. Because once you fired the sort of firing pistol on the first cut, it's just a question of how many more come and where do you get to. But the main point I think to take home is that this isn't the kind of traditional interest rate cuts to rescue a struggling economy or to kind of stimulate growth or whatever. You're going from restrictive policy to normal policy. You're not going from normal policy to what we call accommodative policy, which is this kind of stimulus side. They're basically saying, okay, we've held back the economy for long enough to get inflation under control. Now we think we're getting to that point. We can just kind of try and get back to a normal level for interest rates. And I mean, obviously the US Federal Reserve went the day before, and although they didn't cut, there was a very similar message from Jay Powell. I think they probably feel they're getting to that point as well. And in September, the most likely, obviously barring any weird surprises in between, is that they start their cutting process and produce a very similar set of kind of commentary around, we're just taking the first step in easing our restrictive policy down towards more normal. We don't know where normal is or how fast we will get there. So yeah, I think they both feel that they've got a handle on inflation now, but that doesn't mean we should expect cuts every meeting or big cuts or whatever, because it will certainly be a kind of step-by-step process. But it is obviously a positive, and we'll feel the benefit. The economy will feel the benefit of reduced interest rates.
So politics, interest rates, inflation, what does all of this mean for markets?
Yeah, I mean, obviously that's the big question, right? And if we think of this year, just year to date, obviously a lot's happened as we've discussed at various points. The main story was one of tech stocks in the US doing really well. This kind of AI trend driving mega cap stocks in the US ever higher. What we've seen in the last month, and actually we saw it in the latter part of last year, is as markets come around to this interest rate cutting story, the momentum has very much shifted in the markets. And this is kind of how we've always been positioned, so it's good to have validation of our kind of thoughts. But the simple sort of thesis is that if economies survive this rate of higher interest rates without going into bad recessions, then by the time interest rates are coming down, the growth will broaden out, and you should actually see a more evenly spread performance from the markets. It shouldn't just be led by these narrow stocks. And for us, that means more in mid and small cap stocks, which are definitely cheaper than some of the large cap names. And we've seen that both in the last month, as the markets come around to the Bank of England and the US Federal Reserve getting very close to their first rate cuts. And as I said, we saw it in the latter parts of last year, when there was a big pivot towards actually cuts are coming. So we see there's validation there, and it's been pretty choppy markets, particularly that rotation out of large cap like tech companies in the US in the last few days. Particularly, that's got quite steep. I think the big US technology index, the Nasdaq, is now down 10%, which is kind of a traditional bear market from its peak. But when you consider that in the context of the broader run up, it's still well ahead. It ran up quite a lot, so maybe it's just a bit of the froth coming out. But for us, the main focus is just on, okay, if the economy is okay, it's not going to go into recession. It doesn't have to grow gangbusters. But if the economy is okay and interest rates continue to coast down, we should see good returns for these companies, particularly in this mid and small space where they've been a little bit left behind. And that's been the main story for us over this recent period, is that we've seen validation of that investment case, and that's provided some relatively good returns for us, even though at the market level it has been, the broader market level, it's been a bit choppy.
Brilliant. Thank you, Scott. And thank you for joining us. If you've got any questions about anything that we've discussed today, then please speak to your financial planner. We'll see you next time.